Okay, a very good morning to everyone. Thursday, 31st of August, final day of the month. And just going straight into the briefing then this morning, there's quite a few things I want to cover. A few different angles for the hurricane situation, tropical storm now that is Harvey, that's moving inland, kind of moving northeasterly direction from the initial impact that it had on the Texas coast. So we'll look at that and a few other things to be aware of, because oil, and particularly gasoline, continues to be in focus. We moved above $2 in gasoline yesterday. It was the first time since 2015 that we've traded at that kind of price point. But having a quick look overall at the charts this morning, just seeing a little bit of divergence here in the major pairs. Euro-dollar up, whereas cable's just seeing a little bit of pressure. We've just had some comments out of Bank of England member, MPC member, Michael Saunders, who is one of the most hawkish members of the BOE. Actually, if I just put this onto a minute chart, it might make a bit more sense, because he only spoke a few moments ago. We rallied there up to pivot on the back of his comments. He spoke at 25 minutes past. He said a couple things. He said likely UK GDP will be revised up. He said an early rate rise creates more space to move slowly. Modest rise in Bank of England rate would be helpful. So obviously these all hawkish, but coming from what we know is one of the most hawkish members alongside Ian McCafferty. So these aren't particularly surprising, which is probably why you're not getting much in the way of a sustained reaction here on the back of those comments. And after initially seeing a bit of strength, we have now reversed course on the back of that. Actually, I did see the actual conclusion of his speech. Let me just quickly run over that with you. He said, "I've laid out the factors that persuaded me to vote for a 25 basis point rate hike at the recent MPC meeting, but the path of monetary policy is not preset, and my future votes will depend on the economic data. The MPC has tools to respond either way to swings in the economy as needed." So for me, the conclusion actually is a little bit more balanced rather than those comments which a lot of the newswires originally reported. When you actually troll through the specific words of his speech, the actual conclusion, which is only very short and concise, to me isn't as hawkish. He's talking about that there isn't a preset course, i.e. what he's done before doesn't exactly define his future decisions, and that if he's going to react to incoming data, well, the incoming data on balance has been weakening, you would say. So cable then just coming off a little bit after that initial strength, as I said. Elsewhere, looking at gold, top right, we are down about $3, but we are still elevated in a sense that we remain firmly above $1,300. So if I look at that longer, so 120-minute candlestick, because we were looking at this level yesterday as a potentially a good entry point to reinitiate a long in the market, just given the inherent risks still. The Korean situation, granted, has de-escalated, but still there in the background. You've got the debt ceiling issue still looming. Now that summer recess is basically over and US politicians return to Capitol Hill as of next week. So still enough risk available, if you like, or potential disruptors to the market sentiment to feel more comfortable to still be having a bias that potentially that 1306 level would be a pretty good floor. And I know that last night, just a byproduct, I think, of illiquidity, there was a little bit of a kind of almost like a flash crash, if you like. We dipped briefly at around 1 AM last night to a low of 1302, having opened on that candlestick at around 1312. And I know actually one of the live guys managed to get hit and filled right at the bottom of that, and then so came in this morning up around 40 ticks on side. You know, luck favours the prepared. And those technical levels certainly something to be looking at. Otherwise, US equity markets and European futures, index futures, you can see the DAX here is gapped up slightly. Same case in Eurostoxx and other European indices. In terms of the close on Wall Street last night, S&P up 0.5%, The Nasdaq up 1.2%. I can't remember that often when we've had gains of that kind of magnitude. Granted, it's still relatively small in a historical sense. The Dow was up 0.1%. Actually, the stat of the morning that I've seen was that the S&P, having finished up about 0.5%, is the 4th consecutive daily gain for the index. That actually is the longest streak since May. So, quite phenomenal, really, that such short number of days that the market's been up. Actually, you'd have to go back a couple of months before we put in such a consistent performance. So this, of course, irrespective of the fact that Donald Trump yesterday almost broke his own embargo in a way. The comment immediately afterward from the White House following the missile that flew over Japan at the beginning of the week. White House was fairly measured in response, only for Donald Trump to come out yesterday and basically say that talking is not the answer. Market got a little bit spooked for a couple of minutes, but this is kind of the way that you need to be pretty agile navigating Trump communication, because then essentially the head of the defense, Secretary Mattis, came out a few moments later and said, "We're never out of diplomatic solutions." Completely contradicting, of course, the kind of tone that was issued from Trump. And so people kind of brushed over what the president said pretty quickly. The main feature, though, of yesterday, of course, was economic data. And that's what led to kind of the positive close overall, I guess, in the end. The market got over the fact that there was some fluctuation initially, actually weakness in the US equity market on the back of the data, because many feared that potentially this forces the hand then, or validates the Fed's communication that they're going to tighten policy. But overall, federal funds rate futures are still pricing in a fairly low 30% probability for the December hike. It did fluctuate up to about 40%, but never stayed there. And so actually the market in the later hours of the US trade started to move and grind higher on the back of just the underlying economic health situation more than anything. So ADP, of course, came out. That was the kind of front runner that people often look at ahead of non-farm payrolls. I did read this morning that Deutsche Bank, for one, have upgraded their NFP call to, I believe, 200,000. I think it was an increase of about 20k actually, or 15k to their call, on the back of solely ADP being so strong. Again, that figure yesterday, 237,000, puts us back to levels really that we've not been at since about March time. And that number exceeded market expectations of 183,000. So roughly a 50k beat is pretty sizable. It was also subject to a fairly substantial upward revision as well. So kind of a dual forces there helping on that economic data. And then yesterday, of course, that was followed up nicely by US GDP. And if you're looking at this chart here, again, surprise. This was the second reading, the preliminary reading. So typically you don't see that big a revision, but we had 3% second quarter growth, well above a preliminary reading of 2.6%, beating market expectations of 2.7%. So growth now in the US, you can see it's got above that summer peak of 2016. We're now at the strongest rate of growth, going off 3% since February of 2015. So pretty stellar data that came out. This also coupled with, from the Eurozone, we had the German regional CPI's data, which showed a minor uptick. You had the economic confidence figures coming out of the Eurozone, which were the highest, I think, from memory, July 2007. You've had manufacturing data overnight in China as well, despite showing as you can see here, a minor dip on the service number. Manufacturing, in fact, did pick up and slightly exceeded expectations as well. So looking globally, pretty healthy, robust data out of Europe. Likewise in the US, and overall in China, manufacturing growth perks up. One caveat though is services and construction have weakened slightly on the Chinese side. So it's kind of your global wrap, if you like, of economic data, but overall you would say has been stronger rather than weaker in terms of a context. Okay, moving on. This is kind of what I want to focus on. There's a few things I want to talk about because a lot of people have been looking at oil. A lot of people have been a little bit thrown by this divergent path between gasoline rallying but oil declining. Why would that be? Because yesterday I think there was the Galveston refinery, which is situated on the coastal line, which was one of the first areas impacted when Hurricane Harvey initially hit a few days ago. That actually was one of the headlines where it came back online late yesterday afternoon, and the price of oil rallied quite strongly. Now the reason behind this is because essentially the refiners are doing exactly that. They're refining the crude through that process, and so if they're shut, well then there's no demand for the actual product itself, which is being drilled from the oil wells and the platforms offshore, predominantly in that Gulf of Mexico area. And so it's been the lack of real demand that's led to the decrease in crude. However, with the refinery coming back on, well, it means that they can start reinitiating that process, if you like. So actually, when that happened, gasoline briefly for about half an hour period fell and oil rallied. But overall, the pattern certainly has been the opposite direction. And gasoline hit a fairly significant level. It's touched $2 a gallon, and that is the first time since 2015. So, of course, this is as Harvey's knocked out almost a quarter of US refineries. A couple of things here to be aware of, and this article picks out a couple of key points. Goldman Sachs, for one, they're saying it could take several months before all production could be brought back online. This is in terms of an economic impact in monetary value. According to the president and chairman of AccuWeather, the economy's impact by the time its total destruction is completed, his estimate, 160 billion US dollars. Other estimates have put the economic loss from Harvey at just under 100 billion. Some of the things I've been reading this morning is that the flooding situation is anticipated to get worse going forward. So again, this could have some ramification for those onshore refiners. So it does need to be continued to be monitored. Looking then at a couple of things, a couple of charts. This is from a website called Platts. Not sure whether you guys would have heard of Platts before. This is something that I used to use quite extensively when I was tracking commodities. They essentially are the go-to guys for all things commodities. And so when we talk about oil and reacting to OPEC oil minister comments, that's very top level, I'd say, kind of news analysis. These guys go into breakdowns to the nth degree of specific knowledge and insight and measurement into every single kind of oil well, gas well, oil platform, facility, refining process, and they cover everything: oil, gas, shipping, petrochemicals, you name it. These are the ones of which industry professionals would be using this service quite closely. A couple of interesting things then here that I want to show you. First of all, well, let me just show you. This is slightly bigger. Now, this is looking at the hurricane where it originally hit. Now, this graphic is quite useful because defined by the size of the circle is the capacity of that particular facility. So you can see here Corpus Christi, just on the outer rim of the Houston city center, if you like, and then going further east up the coast, there's a couple of other key refineries which are showing outages at this present point. Now, this I thought was quite useful. Here was a table of which they've put together. Now, the top table shows you plants that have been shut down and their corresponding capacity size. So as we discussed yesterday, Baytown and Beaumont, both of which are owned and run by ExxonMobil, are the largest. And then looking at the plants which are currently at reduced rates or are returning at this point. And then calculations of the share of US capacity. Now, I find these charts or tables can be quite useful because it will help you then identify the type of information that you see and hear during the day and whether or not it carries much importance or not. And so these are probably worth having to hand as crib sheets. I did share them in the chat room earlier. The other thing that I'm looking at here, and I've seen quite a few people talking about this morning, is the path now of which the tropical storm Harvey is moving. Now, we've looked at this before. Thursday, Friday, and into the weekend, essentially it is leaving the Gulf of Mexico and it's kind of northeast bound, if you like. Now, this is very interesting because I want you to visualize this graphic here and the projected path of Hurricane Harvey. Now, I want to switch over and I want to look at this. This is the Colonial Pipeline Company System map. Now, something here you'll recognize. This is the actual pipeline coming out of Houston, Texas. So if you think of the Gulf of Mexico is the sweet spot, it's the hub of North American gasoline, crude oil, and so on coming out of the country to then service the more higher density population areas of the east coast of America. So there's a pipeline basically carrying this all the way from Houston, Texas, all the way up going towards New Jersey, north of North Carolina. Now, one thing you'll notice here is the path of the hurricane. So you can see here, Louisiana, Mississippi, going through then Alabama, but near Tennessee. Louisiana, Mississippi, Tennessee. So at the moment, the hurricane, you could pretty much, is following exactly over the pipeline system. And it has meant that the pipeline is running at the moment at reduced rates. And the interesting thing here that I'm reading is that if we go to here in the FT, there's a couple of interesting points to cover. Because the Colonial Pipeline shuts a key fuel artery. And so what they're looking at here is this is the carrying of Gulf Coast refining hub to the East Coast. Now, to put this in context, Colonial, which is the biggest single fuel transporter in the US, shipping more than 2.5 million barrels a day on its line, or roughly 1 in every 8 barrels of fuel consumed in the United States of America, goes through that pipeline. So one can only imagine the disruption then, i.e. what a driving force this would be for gasoline prices if that was to be shut down completely. Now, Harvey has knocked out at least a fifth of US refining capacity at the moment, but going forward, this is going to need to be watched very closely because Colonial feeds markets such as New York, Washington, D.C., Atlanta. East Coast cities have become more and more reliant on the flows from that pipeline after a number of old, less profitable refiners shut down in the region over the past decade. So these are the reasons why gasoline, this would be one of the major factors of why gasoline's been on such a tear at the moment and managed to get itself above $2 a gallon for the first time in 2 years. And so if you hear updates concerning the Colonial Pipeline, you definitely need to be switched on. For the live guys, if you're trading gasoline, that for sure. But then also just the general energy complex as well. So I hope that just makes a bit of sense and maybe covers a few things that you might not have been aware of. Okay, quick look at the calendar. Oh, actually, before I look at the calendar, there's a few things that I want to have a quick look at, other stories. Just before I do that, be aware in 2 minutes' time, so while I'm talking, I will try and cover it, but if you're looking at your charts and your trading terminals at the moment, you've got the German jobs data coming out. So let me just give you your own quick rundown for that. This is the German unemployment change and rate. I would just keep a half an eye on this if you're looking at the euro or European assets. But just a few other things to be aware of. A lot is being made at the moment of the lack of progression in the Brexit talks. Devil in the detail, why Brexit talks are making little progress. This is an article on Bloomberg this morning. The UK seems almost reluctant to talk about the divorce bill. Europe's keeping a pretty firm stance that we need to get that out of the way before then really we can know what we're talking about. Barnier and David Davis, the two negotiators of either side, they're speaking to reporters said to be around midday today. So I would be aware of that if you're trading the British pound. And then the other thing, talking with the UK, is Theresa May yesterday has said she's going to stand for re-election. Not sure how likely it is of her getting re-elected. This is trying to... Her tactic here is putting to bed rumours that circulated at the weekend that the Sunday Mirror reported that basically she's going to step down in August of, I think it was 2019. But she's tried to negate that by saying that's not the case, it's untrue, and actually I'm not a lame duck premier, which is the terminology often used in politics. So that's something else which quite a few people are looking at. Tory lawmakers are said to have laughed at the idea that she'll lead them in another vote. Now this is quite interesting from a timing perspective because of course the 1st to the 4th of October every year is the Conservative Party conference. So we've only got about 4 weeks until that happens. The one thing I'd say is even though Theresa May has said she'll want to stand for re-election, you know, one word of advice when it comes to politicians saying anything and promising anything, I put very little faith in that actually coming through to fruition. And that's not just picking on Theresa May, that's just politicians in this new current environment. That what they say on one day might not necessarily stand the next. So I wouldn't mean this necessarily changes the risk about potential, albeit low probability of leadership change. Okay, just to update you then, German data has just come out. So you've got the unemployment, 5,000 estimated for 6,000. So the unemployment rate was, as expected, 5.7%. The actual unemployment change, minus 22,000, is what I've got run on our news feeds here. Expected was for a minus 6,000. The adjusted figure, though, looks like it was 5,000. It doesn't look like much reaction on the back of that. Okay, looking further forward, there is actually quite an interesting number coming out at 10 a.m. this morning, that being the Eurozone inflation figure. Now, obviously, you had the Jackson Hole Symposium at the end of last week. People were eagerly awaiting Draghi to talk. Potentially, he could have deemed the value of the euro at around 120 as getting to a point of being a problem for the ECB at the risk of it overshooting if they were to go ahead and tighten policy. However, he essentially said nothing on the matter. Inflation, though, is very critical to the ECB's path that they wish to follow with the communication of tapering QE in the months ahead. So inflation data 10 o'clock will need to be watched very closely. And then moving on into the US afternoon, we have what's often deemed as the Fed's one of their premier kind of data points that they monitor for their decision making. This is the core PCE number. That's coming out at 1:30. That'll be alongside the regular jobless claims. You've then got Canadian GDP. Later, then you have Chicago PMI. As ever, just be mindful of the early release to subscribers before the embargoed release at 2:45. And then you've got pending home sales and then nat gas storage change coming out. So quite a busy afternoon in store for the US markets. Obviously still monitoring anything out of Trump. He did talk about tax yesterday, but basically focused on why the tax system needed to change rather than actually providing any details as to tax changes. We've kind of priced as a market now that the tax cut, if anything, is probably going to be more targeted to 20%. As a drop from the current 35, but he's seemingly still pushing this idea of 15%, which most would foresee as being highly unlikely, a cut of that kind of size or magnitude. Okay, going to leave it at that. Coming up to 9 o'clock this morning, so that's your morning briefing. Obviously, happy to talk about technical setups and charts from that perspective in the chat room. If you have any questions or want to share any ideas. Yeah, guys, have a good day. Thank you.